Imagine it's 1998. The internet is exploding onto the world stage, and excitement is everywhere. Investors are throwing their money into anything that ends with .com. New companies are launching overnight, and everyone believes they've found the future. You buy into the hype, put your savings into tech stocks, and for a while, it feels like the smartest move you've ever made. Prices soar, headlines scream about the new economy, and success seems guaranteed. Until it isn't. By 2000, the dream collapses. The Nasdaq, the index most tied to technology, falls by nearly 80%. Billions in wealth vanish. Ordinary investors lose their savings. Even giants like Cisco, Intel, and Amazon see their shares plummet by over 90% from their peaks. Half of all the flashy new startups disappear. For many, it's a financial disaster. For others, it's a hard-earned lesson about euphoria and excess. But even in that destruction, there was a truth. The internet was the next big thing. It changed everything. Our work, our shopping, our communication. But before the long-term value arrived, the hype had to burn away first. The same story has repeated countless times in history. Railway booms, housing bubbles, cryptomanias. Each time, the details differ, but the human psychology remains constant. Greed, excitement, and the fear of missing out. Now, fast forward to today. It's not the internet this time. It's artificial intelligence. Everywhere you look, AI dominates the conversation. From the rise of ChatGPT to autonomous cars, machine learning, and robotics, the world is convinced we've entered a new era of innovation. Headlines call it the fourth industrial revolution. Governments are investing billions, and tech companies are pouring money into AI at a scale that dwarfs nearly every previous technology cycle. The question is, are we witnessing the dawn of a new technological age or the beginning of another bubble? History doesn't repeat, but it often rhymes. What we're seeing now has striking parallels to 1999. Extreme valuations, stories of overnight millionaires, and a sense that if you're not in on AI, you're being left behind. Consider this. The entire US stock market is now heavily concentrated in just 7 companies. Amazon, Apple, Microsoft, Meta, Alphabet or Google, Tesla, and Nvidia. Together, they account for roughly 30% of the S&P 500's total value as of mid-2024. This kind of concentration is rare and risky. These companies are locked in an arms race to dominate AI, and their spending reflects it. According to industry estimates, combined AI-related investments by the major tech firms could approach $300 billion this year. This figure represents a broad aggregation of capital expenditures across these companies, which includes infrastructure for AI, but also spending on logistics, data centers, and other business areas. It's a composite estimate, but it illustrates the staggering scale of this technological push. Nvidia, the world's leading maker of AI chips, has become the star of the show. Its market value has soared by over 1,000% since 2020, driven by demand for its powerful GPUs. Amazon and Microsoft are spending tens of billions expanding cloud infrastructure for AI computing. Google is rebuilding parts of its search engine to be AI native. Meta is investing in both AI and the metaverse. Even Apple, long cautious about hype cycles, has quietly boosted its AI research budget to make Siri relevant again. The spending spree is historic. It's larger than the GDP of many developed nations, and much like the early 2000s, optimism has become its own fuel. Investors are not just betting on profits today, they're betting on a future that hasn't yet arrived. AI has already proven its potential. Tools like ChatGPT, Midjourney, and Claude have captured the imagination of millions. Businesses are experimenting with AI-driven automation, customer service bots, and creative tools that generate everything from art to code. There's no doubt that AI will play a major role in the global economy. The challenge lies in timing and scale. The International Monetary Fund estimates that around 60% of jobs in advanced economies could be affected by AI, either transformed or replaced. That creates both enormous opportunity and deep uncertainty. If AI delivers on its promise, productivity could surge, costs could fall, and new industries could emerge. But if the returns arrive slower than expected, or if the technology has limitations, valuations could crumble just as fast as they rose. We've seen this dynamic before. In every major technological revolution, the early phase is driven not by profits, but by belief. Belief that the next breakthrough is around the corner. Investors pile in, valuations soar, and the story becomes self-reinforcing. Then, when reality fails to meet expectations, the correction arrives. One of the most concerning trends today is how intertwined the biggest players in the AI race have become. Many analysts have pointed out that companies like Microsoft, OpenAI, Nvidia, and Oracle are engaged in what some call a circular economy of hype. Here's how it roughly works. Tech giants invest in AI startups like OpenAI. Those startups in turn use the investors' cloud services, often paying billions back to their investors for computing infrastructure. The investors then use that revenue to buy chips from Nvidia. Nvidia, meanwhile, invests part of its portfolio back into the AI ecosystem by funding or partnering with the very same companies that buy its products. The cycle boosts reported revenues and valuations across the board. It's not illegal or necessarily unethical, but it creates the illusion of unstoppable growth. Money circulates rapidly within the same network of companies, inflating their apparent strength. If demand cools or real-world profits lag behind paper valuations, this web of interdependence could quickly unravel. We saw a similar feedback loop during the dotcom bubble, when advertising dollars flowed in circles between internet companies that barely generated real revenue. AI has advanced at astonishing speed, largely because it has been trained on vast amounts of human-generated data: books, articles, videos, images, and conversations. But there's a growing challenge on the horizon. We may soon run out of high-quality training data. Researchers call this the data wall. Some estimates suggest that by 2027, AI systems could have exhausted nearly all publicly available text and image data on the internet. That could slow down progress, as models would have fewer new examples to learn from. Without new data, improvements might plateau, forcing companies to seek synthetic data or create simulations, an approach that risks reinforcing existing biases or errors. However, not all experts agree that this wall will be a permanent obstacle. Some believe it can be overcome with more efficient algorithms, synthetic data generation, or proprietary data licensing agreements. In other words, the data wall is better viewed as a challenge or risk, not an inevitability. It's not a guaranteed outcome, but it's a real possibility. The pace of AI improvement may not continue indefinitely, And if the technology's progress slows while stock prices assume exponential growth, the resulting gap between reality and expectation could lead to another painful correction. That's the question investors always ask, and the phrase that Sir John Templeton famously warned about. The 4 most dangerous words in investing are, "This time it's different." In some ways, this time is different. The leading AI companies today have enormous cash reserves, profitable business models, and real products that millions use daily. They're not speculative startups with no path to revenue. Microsoft's cloud division, for instance, generates billions in profit every quarter. Google and Meta are advertising powerhouses. Nvidia sells physical chips that are in genuine demand. These are not companies built on pure hype. However, being profitable doesn't make them immune to bubbles. Even great companies can become overvalued when investors project too much perfection into the future. Amazon, after all, was a real company with a real business in 2000, and its stock still fell over 90% during the crash before eventually recovering. So yes, there's substance behind the AI boom, but there's also speculation, overconfidence, and herd behaviour. The question isn't whether AI will shape the future. It's whether investors are paying too much too soon for that future to arrive. The truth is, nobody can predict exactly how this story will unfold. The AI revolution could continue for another decade, or it could cool off next year. But investors can learn from the past and take a few timeless lessons from those who lived through previous bubbles. Beyond the stock market, the AI revolution raises deeper questions about society, ethics, and power. If 60% of jobs are at risk of automation, what happens to workers displaced by machines? How will governments adapt their policies? And how will humanity preserve creativity, compassion, and purpose in a world increasingly run by algorithms? These are not questions investors can ignore. The companies racing to dominate AI aren't just shaping technology. They're shaping the future of work, privacy, and even identity. For all the excitement about profit and innovation, there's also a moral dimension. Will AI serve humanity, or will humanity end up serving it? The pursuit of progress is good, but unrestrained ambition has a cost. We saw it with the railroads, with the internet, with crypto, and we may see it again with AI. That doesn't mean we should fear the future. It means we should approach it with wisdom, humility, and awareness. Every generation faces a moment when technology promises to change everything. The temptation is always to believe that we've entered a new era where the old rules no longer apply. But time and again, markets remind us that fundamentals, value, patience, discipline, never go out of style. AI may well be the most transformative technology since electricity or the internet, but that doesn't mean it's immune to excess. The hype, the circular investment flows, the staggering spending, these are warning flashing lights on the dashboard. They don't mean the engine will fail, but they do mean you should drive carefully. For long-term investors, the best strategy may be the simplest. Stay diversified, invest regularly, keep your emotions in check, and remember that no boom lasts forever. If you can do that, the next correction, whenever it comes, won't be something to fear. It'll be an opportunity. Because bubbles come and go, but wisdom, discipline, and perspective endure. And maybe, just maybe, that's what we need most right now. Less excitement, more understanding. Not panic, but patience. Not greed, but gratitude for the chance to learn from history before it repeats itself again.